If you had $1,000 right now, where should you invest it in the U.S. stock market? Most people either freeze or make the biggest mistake, putting everything into one stock. In this video, I'll show you 8 U.S. stocks, including small dollar and high potential companies, explain how many shares you can buy, and most importantly, how to divide your $1,000 smartly so you reduce risk and increase long-term potential. Watch till the end because the strategy matters more than the stock. Investing your first $1,000 is exciting, but also dangerous if you don't understand allocation. This is not about gambling or get-rich-quick stocks. This is about building a smart beginner portfolio, mixing small-price growth companies with strong, established U.S. leaders. Let's start step by step. The first company is Waterdrop, trading around $1.80 per share. This is a small-cap company operating in the digital insurance and financial services space. Because the price is low, even a small investment gives you many shares. If you invest $150, you can buy approximately 83 shares. Stocks like this can grow faster than big companies, but they also carry higher risk. That's why we never go all in. Next is Ding Dong, priced around $2.50 per share. This company operates in the online retail and delivery space. With an investment of $100, you could buy about 40 shares. This is a speculative stock, high risk, but also higher potential if the business turns around. Third is WM Technology, trading near $0.80 per share. This is a very low-priced microcap stock. If you invest $100, you could buy roughly 120 shares. Stocks at this level move fast in both directions, which is why they should only be a small part of your portfolio. Now let's move to a slightly stronger small-cap company. CI&T trades around $4.50 per share and works in digital transformation and tech services. With $100, you could buy around 22 shares. This stock represents a balance between low price and business stability. Next is Cricut, priced around $5 per share. Cricut sells creative and crafting machines and has a loyal customer base. If you invest $100, you can buy roughly 20 shares. Consumer niche companies like this can perform well when demand returns. The sixth stock is VAALCO Energy, trading near $4 per share. This is an energy company, and energy stocks are cyclical. They rise when oil prices rise. With $100, you could buy around 25 shares. This adds sector diversity to your portfolio. Now let's talk about a giant, Apple. Priced around $250+ per share, is one of the strongest companies in the world. You may think $1,000 isn't enough, but with fractional shares, you can still invest. If you put $200 into Apple, you would own about 0.8 shares. Apple brings stability and brand power to your portfolio. The final stock is NVIDIA, trading around $190 per share. NVIDIA is a leader in AI and advanced computing. With an investment of $250, you could own around 1.3 shares using fractional investing. This gives exposure to long-term AI growth. Here's how a smart $1,000 split could look. 150 in Waterdrop, 100 in Ding Dong, 100 in WM Technology, 100 in CI&T, 100 in Cricut, 100 in VAACLCO Energy, 200 in Apple, and 250 in NVIDIA. This way, your money is spread across multiple sectors and risk levels. Putting all $1,000 into one stock is risky. If that company fails or drops, your entire investment suffers. By dividing your money, you protect yourself. Some stocks may go down, but others can go up. That's how long-term investing works. If you only remember one thing from this video, remember this: diversification beats prediction. You don't need to find the perfect stock. You need a balanced plan. Start small, invest consistently, and always do your own research. If this breakdown helped you understand how to invest $1,000 smartly in the U.S. stock market, like the video and subscribe to Trulyx for simple, honest investing explanations. See you in the next one.